All right, let's dive right into this. Welcome to today's Explainer, where we're putting a really fascinating investment memo under the microscope. We are looking at Ingredion, an industrial ingredient company that has Wall Street completely divided right now. The central tension we're exploring today is simple, but it's high stakes. At its current price, the stock looks incredibly cheap. But is it a hidden gem ripe for a massive rebound? Or is it a classic value trap just waiting to catch unsuspecting investors? To figure that out, we're going to frame this entire explainer around one singular objective question. Is Ingredion a high-quality, exceptional long-term investment at its current price? We aren't looking for just okay here. We're going to stress test the optimistic bull case against the gritty operational realities this company is actually facing on the ground.
And the reason this question is so urgent right now comes down to a single number: 6 times. That's Ingredion's exceptionally cheap valuation multiple. Specifically, its enterprise value to its last 12-month adjusted EBITDA. Look, in a market where premium compounders trade at massive premiums, a multiple under 6 looks like an absolute steal. This low number is exactly what's catching Wall Street's attention and bringing value investors to the table. But, as we all know, cheap doesn't always mean mispriced, right?
Okay, let's move to Section 1, the Ingredion story, a quick look at their strategic pivot. To really understand their current strategy, you have to see how they evolved. Ingredion started out back in 1997 as a spin-off, heavily rooted in capital-intensive corn refining and basic sweeteners. But management knew that pure commodity processing just wouldn't command a premium valuation, so they pivoted. The defining moment was acquiring National Starch in 2010, and then a complete rebrand to Ingredion in 2012. This was to signal their new identity as an ingredient solutions provider. Fast forward to the present day, they've announced a massive 2026 deal to acquire Tate Lyle, essentially doubling down on this whole specialty shift.
Which brings us to Section 2, the bullish transformation. Let's look at the optimistic thesis.
If you're an optimist, there's actually a lot to love here. Management has this incredibly coherent strategy to transition away from cyclical commodities and move toward higher-margin specialty ingredients. Alongside that, they have a solid history of generating strong cash flow and expanding global manufacturing footprint, and as we mentioned, those visibly cheap valuation multiples. On paper, it's a very compelling narrative. And the absolute crown jewel of this bullish narrative is a segment they call T&HS, Texture and Healthful Solutions. This is their specialty segment focused on high-value, clean label, and sugar reduction ingredients. Make no mistake, this is the growth engine. This solutions platform is what's supposed to drive the company's margins up and make their customer relationships incredibly sticky.
But let's step back for a second. Section 3, the operational reality check. Because this is where the story gets significantly more complicated.
The reality of where their money actually comes from is super revealing. Notice how much of this pie is still tied to their old-school business. Looking at their projected 2025 segment operating income, nearly 48% is still driven by Latin America. Meanwhile, that highly celebrated specialty segment, TNS, only accounts for 39%. So despite this massive specialty pivot we keep hearing about, their legacy regional operations still carry the heaviest earnings weight. A truly great business should be unmistakably pulled by its highest quality segment, but Ingredion is still materially funded by legacy starch and sweetener economics. And here's the catch. Relying on legacy manufacturing means you are vulnerable to operational hiccups. Which brings us to the Argo plant failure. In the first quarter of 2026, severe production challenges at their major Argo facility in the U.S. completely derailed their results. Remember, for a company that essentially sells manufacturing reliability to its customers, a plant failure of this magnitude isn't just background noise. It's a major red flag that their operational moat might be way shallower than advertised. Just look at how severe the impact was. A 63% collapse in segment operating income for the U.S. and Canada in a single quarter. Sure, the specialty segment held steady, but this single facility failure severely damaged overall profitability. It even forced management to issue a painful guidance cut for the rest of the year. It just proves that execution risk is still a massive factor here. Which leads us to Section 4, the Tate Lyle gamble. Precisely when the company is dealing with these operational headaches, management introduces a real wild card. In June 2026, Ingredion announced a multi-billion-dollar all-cash acquisition of Tate Lyle. Right after this deal closes, their projected leverage ratio, that's net debt to adjusted EBITDA, spikes to 3.0x. That is a heavy debt load being introduced
exactly when the company's core operations are structurally fragile and absorbing guidance cuts.
So we're building up this precarious wall of compounding execution risks. Think about it. Management is taking on a massive, complex cross-border integration while simultaneously dealing with unresolved Argo operational issues. Add to that an interim CFO transition and the fact that the board actually waived its own CEO retirement policy just to keep leadership in place. The board is acting highly confident, sure, but a skeptical investor might look at this list and say, hey, I need to see some proof of stability before taking on transformational M&A risk.
Plus, their capital allocation choices heading into this period have been questionable. In late 2025, management was aggressively buying back stock at premium prices, between $108 and $121 per share. Buying back stock at those highs, literally right before an earnings reset, a guidance cut, and a massive debt-financed acquisition, that kind of weakens your confidence in management's internal read on their own business.
All right, let's bring it all together. Section 5, the final verdict. Buy or watch?
Let's briefly juxtapose the two realities we've uncovered today. The bull case offers us a visibly cheap stock, growing specialty segments, and really high cash flow. But staring right back at us is the bear case, that Argo plant failure, a heavy reliance on legacy Latin American operations for actual profits, and some massive integration and debt risks tied to the Tate Lyle deal.
When we map this out directionally in our scenario table, the asymmetry is pretty striking. Yes, if everything goes perfectly, meaning specialty dominates and the deal succeeds, the bull scenario suggests a value around $159. Pretty great. But look at the bear scenario. If operational friction continues and the deal creates an overhang, value drops all the way down to around $76. The downside is highly plausible because, frankly, it doesn't require a global recession. It just requires management to keep stumbling on execution.
Which brings us to our ultimate conclusion from the memo. Ingredion clears the bar for a solid industrial ingredient company. It does not clear the bar for exceptional long-term investment quality. It's a good business for sure, but it's fundamentally a watchlist candidate right now, not a high-conviction buy. The margin of safety just isn't wide enough to compensate for the execution risks currently embedded in the story. So I'm going to leave you with this exact metric to watch in the coming quarters. Will management prove specialty growth can dominate without relying on legacy spreads? Because until they can operate their legacy plants without catastrophic failures and seamlessly integrate their new acquisitions, that question remains dangerously unanswered. Keep a close eye on their segment earnings in the next few reports. That's going to tell you everything you need to know about whether this company has finally become truly investable.